Hello and welcome to the week ahead. I'm Brenda Kelly. Well, the week just gone by has been a very interesting one, and certainly when it comes to US data, we've seen quite a mixed bag. We've seen some misses on services PMI, we've seen misses on housing data, and yet today we saw the last quarter GDP beat expectations, coming in at 1% versus the consensus of 0.7%. Now, a lot of that is down to inventories, so it does actually tell you that we might actually see a weaker growth picture in the first 3 months of 2016. Next week, however, I think everything will be in or around where the non-farm payrolls are going to be. And while we've seen some massive expectations over the last few months, those have been dialed down a little bit now to 195,000, with the unemployment rate expected to stay in or around the 4.9%. Now, of course, there are lots of speculation and stories out there as to whether or not the US is entering a recession. And ultimately, one data point does not necessarily give that particular picture. But the markets are certainly not pricing in any rate hikes in the very near term. There's like a 10% probability priced in the swaps market at the moment for a rate hike in March. So you can be safe to say that we won't be looking at anything there for the time being. Over here in Europe, though, we are going to be looking at inflation data. And of course, it's the last entire week before we actually see the ECB make their decision on what stimulus package we're going to see in order to stoke inflation and hopefully growth as well. So ultimately, core CPI data will be very closely watched, as will that of Germany's, because that will give us an idea as to exactly how aggressive Mario Draghi is going to be. In terms of the trade idea there, euro-dollar has been a very interesting pair to watch, or even actually not very interesting pair to watch, but it does seem to be looking at this range at the moment. And while we are within the 110, 110.50 level, there is a propensity for us to move higher. But ultimately, what we will be doing is keying in expectations for some sort of stimulus from the ECB, which could drive it that bit lower. So as it stands, we are looking at that 110 level to actually break, possibly the 109.50 to come in as your actual support level. If that breaks, that will confirm a retest of the late January lows, which comes in at around 1.08. Anything above 1.1150 would actually negate that particular transaction. But for the time being, the fundamentals would spell euro downside versus dollar upside. Tuesday will also give us a little bit of information in regards to China. And of course, this has been something of concern over the last number of months and has been to blame by many counterparts as to why we've seen some choppiness in equity markets as well. Now, we have the G20 summit taking place in Shanghai as we speak. And there is, I suppose, a certain amount of warnings coming from certain members there to Beijing about what they need to do when it comes to weakening or devaluing the yuan. And they have obviously said that doing something similar to what they did back in August, which caused such a massive rout, is not really acceptable. Nevertheless, the data from China is not expected to be all that great. We've got manufacturing PMI, non-manufacturing PMI, all due to come in around the 49.4 to 50 mark, ultimately very much in the middle of the road and not giving us any sort of inclination to expect that growth is going to pick up there anytime soon. Here in the UK, we will be looking at PMI data as well. Particularly, we've got construction PMI on the Wednesday, but ultimately, it's the services PMI that we'll be watching for very, very closely. It's expected to come in around 55, and of course, it's such a massive part of the UK economy, it could give the pound a boost. Now, the pound did actually fall to some massive multi-year lows recently, and it has since started to oscillate the 140 level against the US dollar. As it stands, again, the fundamentals would spell that the pound should weaken that bit further against the US dollar. So we're looking for it to remain below that 140 level, the key resistance around 140, 150, and then we would look to those lows that we saw at the earlier part of this week to hold around the 138.50. If they don't, then we've got to move back down towards 137. Naturally, this rally that we've been seeing in equity markets could be subjected to a degree of volatility given the plethora of data that is due next week. And we should keep an eye on the risk assets versus the safe haven assets, and gold is one of those. Certainly, we've seen a massive move in gold prices over the last number of weeks. And while above that 1190 level, there is a propensity for it to move that bit higher. I would be looking at it at the moment, consolidating these gains, despite the fact that we've been seeing these better risk appetite. But we haven't seen these rallies in equity markets last for any more than 3 days since the beginning of this year. So all bets are really on hold as to whether or not they can be sustained. So while gold is above 1190, there is a potential for us to move up to that 1255-65 resistance level, and a breakthrough there could actually target the 1280 to 1300 level. On the flip side, if we actually come back down through the 1220 level, then we will be targeting that 1215, 1205. But as it stands, the longer term view is above 1190, key support level there.